Welcome back to the Quick Take series where we make investment thesis analysis in less than 5 minutes. Today we are talking about Netflix, which needs no introduction. It is a giant in the streaming services where it provides entertainment, TV series, documentaries, feature films, mobile games across various genres and languages. The qualitative analysis is that Netflix is arguably the leader in the streaming sector with the first mover advantage. Netflix revenue and the number of users have increased massively in the last 10 years. And that is thanks to the great success that Netflix as a business has had. It is profitable, but it still has negative free cash flows. Margins have improved steadily over the years, aside from free cash flow margins. Netflix unfortunately has enormous liabilities. It has $29 billion in total liabilities and $23 billion in content obligations. Watch out for these content obligations because when you read the earning report, these 23 billion do not end up in the total liabilities. So they are on top of that. And all this is as compared to only $8 billion that they have in current assets, including cash. So they have much less current assets than total liabilities. However, the current ratio is very close to 1. So within the next 12 months, they shouldn't have problems pay their debt. But in the long term, they will need cash. The company has already hit extremely high user penetration in North America and Europe. There are low growth prospects therefore in these geographies, but it can still grow massively in Asia Pacific and Latin America. Moreover, it might be able to raise membership prices further due to its pricing power. Furthermore, it might explore additional growth drivers outside of streaming, like gaming or even adding advertisement or other revenues. For the quantitative analysis, I have calculated the present fair value to be $250 per share. And this was thanks to a discounted cash flow valuation where I assumed a 15% earnings growth compounded through 2031 with a 10% discount rate and a 20 PE multiple in 2031. Today, the stock crashed massively, 30+%, due to the fact that they reported yesterday Q1 earnings. And for the first time, Netflix lost subscribers instead of adding. They lost 200,000 subscribers. So the stock now is trading around $220 per share, which is close to my fair value calculation. However, before jumping in the stock, I still want to see in the next few quarters how subscribers will evolve, and then I will update my valuation model. For the risks, competition is getting fiercer by the day. Disney Plus, Amazon Prime Video, Apple TV, Hulu, etc. And a competitor like Disney has a lot of free content, meaning they make content anyway and then they can upload it on the Disney Plus platform. Whereas Netflix needs to spend a lot of money in making new content creation or leasing it. So that raises question in what are the long profitability prospects of Netflix? Furthermore, there has been a lot of sentiment change around the stock due to the fact that in Q1 2022, Netflix has printed a 200,000 subscribers decline. So investors may no longer view Netflix as a growth stock, and consequently the multiples may come down. Lastly, North American and Europe users are near saturation. Yes, there is a lot of growth possible in Asia Pacific and Latin America, but North American and Europe users cannot grow that much more. If you appreciate these quick takes company investment thesis videos, click the like and don't forget to subscribe. See you in the next video.